Somebody is sitting on 700,000 Bitcoin, and the second they sneeze in the wrong direction, the entire crypto market catches a cold. We're not talking about a whale, we're talking about a creature so large it makes whales look like goldfish, and what happens when it decides to sell is one of the most fascinating and terrifying liquidity puzzles in modern finance. Let's set the stage with one uncomfortable truth. The total Bitcoin traded on any given day across major exchanges sits somewhere around $20 to $30 billion in volume. Now imagine someone needs to offload a position worth, at current prices, somewhere north of $60 billion. That's not a trade, that's a geological event. Think of the order book like a swimming pool, and most sellers are cannonballs. They make a splash, the water settles, life goes on. But a 700,000 Bitcoin seller isn't a cannonball. It's like someone trying to drain the ocean through a garden hose. Except the ocean is the market, and the hose is whatever liquidity exists on the other side of that trade. Here's where it gets technically beautiful and practically terrifying at the same time. Market depth measures how many buyers exist at each price level below the current price. The deeper the market, the more you can sell without moving the price dramatically. But Bitcoin's order books, even on the best days, are nowhere near deep enough to absorb this kind of position without serious pain. So how would this hypothetical seller actually execute? There are essentially three roads: block trades with institutional counterparties, over-the-counter desks that match buyers and sellers privately, or a staged sell program that dribbles supply into the market over weeks or months. Each has trade-offs, and none of them are clean. Think of it like trying to quietly leave a party you threw, except everyone is watching and your exit is the door. The OTC route sounds elegant on paper. Find a sovereign wealth fund, a hedge fund, or a corporate treasury willing to absorb chunks at a negotiated price and bypass the open market entirely. But even OTC desks have limits. And a position this size would likely require discounts of 5 to 15% just to attract enough demand, meaning the seller is already losing billions before a single coin hits a public exchange. The staged sell program is probably the most realistic playbook, and history gives us a useful reference point. When governments and estates have liquidated large Bitcoin positions, think the US, Marshal Service selling seized Silk Road coins in 2014. They auctioned them in tranches over time, and markets still moved noticeably. Spreading sales over 6 to 12 months reduces the daily market impact, but it introduces a different risk. The market figures out what you're doing, front runs you, and now you're selling into a weakening bid that you helped create. This brings us to one of the cruelest ironies in large-scale liquidation. The act of selling is itself the signal that causes prices to fall, which forces you to sell more to meet your targets, which causes prices to fall further. It's a feedback loop that traders call impact costs. And for a position this size, the impact cost could literally be tens of billions of dollars in slippage. You start selling at $60,000 per Bitcoin, and you might be finishing at $45,000 per Bitcoin, not because sentiment changed, but because you changed it. Now, let's talk about what this does psychologically to the rest of the market. Because price mechanics aren't just mathematical, they're deeply human. Retail investors see a widening spread, unusual volume, and a price that won't stop falling. And they don't think, oh, a large holder is executing a staged liquidation. They think something is wrong. Panic selling accelerates, and suddenly the fundamental cause of the drop is dwarfed by the emotional amplification that follows it. The misconception worth killing right now is that a big seller always means a crash that's too simple. If the selling is slow enough, well distributed enough, and absorbed by genuinely deep institutional demand, markets can digest enormous supply with far less drama than people expect. The key variable isn't the size of the position, it's the ratio of that position to available liquidity. And liquidity is not a fixed number. It expands when confidence is high and evaporates when fear takes over. Practically speaking, the lesson history keeps teaching us is that the most dangerous trades aren't the ones with the biggest positions. They're the ones with the worst execution strategy relative to available liquidity. Disciplined, unemotional selling programs that respect daily volume, maintain confidentiality as long as possible, and account for market impact in their pricing expectations will always outperform panic, urgency, or overconfidence in the market's ability to absorb what you're offering. For you as an observer or a participant in these markets, the actionable insight is this. Size your positions relative to the liquidity of the asset, not just the size of your conviction. A position you can't exit without destroying the price is not actually a position. It's a trap you built for yourself with your own capital. There's something almost philosophical about this whole scenario. The more Bitcoin you own, the less freedom you have to sell it, which means the largest holders in the world are simultaneously the most powerful and the most illiquid participants in the market. Power and liquidity trap exist in perfect, ironic tension. And that should make all of us a little more humble about what owning a volatile asset really means at scale. We don't fear this scenario, we find it clarifying, because it reminds us that preparation, process, and sizing are always more important than any single conviction or market call. Whether Bitcoin absorbs the selling gracefully or buckles under the weight of it, the investors who survive and thrive will be the ones who understood liquidity before they needed it, not after. And if you want to put your capital to work in smarter, more liquid, and more strategic ways, whether that's real estate investing, home contracting projects, or finding the right lenders to back your next move, check out our links in the description below.